Hey everyone, today on the final bar, we'll hear from my guest JC O'Hara from MCAM Partners, helping us make sense of this whippy market environment, look in particular at technology at the Qs and making sense there. We're also going to have a segment called It's All Relative. The idea is to think about relative performance in this sort of challenging environment, more bearish leaning environment. What stocks are actually getting it done? We'll screen some ideas for you. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Happy one-day bull market to all of you as we rally dramatically into the close. A nice change of pace. We've had so much distribution and thinking about what that means. Today, I feel like a rare update, obviously driven by big strength in energy. With energy at one point up over 10%, settling down, but still up 9.25%. So a big drive higher by energy on speculation of oil prices, holding in or not going down as much. Starting to see some improvement there, and what that would mean for a lot of companies. We talked about stocks like Chevron that are decent dividend payers, but the risk is how much could they sustain that given challenges to their business, given low oil prices, and at least for today. Certainly seems there's a vote of confidence on the ability of sustainability of some of those models. So we're going to get to that when we talk about relative performance a little later. I did want to highlight some of the great guests that we have on this show, and also some of the events on StockCharts TV. Tomorrow we actually have Jay Woods, who is normally would be coming to us from the floor of the New York Stock Exchange. He's one of the executive floor governors, but is working remotely, as many of us are, but agreed to jump on and just tell us a little bit about what he's seeing, but also just the experience of being a floor governor from off floor. On the 7th next week, on Tuesday, we're actually going to do a special called 7 Bear Market Mistakes. I'm going to give you my sort of bear market playbook, things I think you can learn. I've learned at least from previous bear market cycles. So hopefully some good tips for all of you. Then we have some fantastic guests. Harry Boxer on Tuesday, Wednesday, Jesse Felder, and then John Kosar from Asbury Research on April 9th. Also, just wanted to highlight there's an event going on right now, today and tomorrow, called Tech Wizards 2020. I'm actually going to be speaking tomorrow in particular about relative strength, how it could fit into the overall trading approach or trading process. So check that out. There's a link on the screen. You can get over to that event, and hopefully you'll see you on the virtual conference, my presentations tomorrow. So let's get to the market recap here. And again, if you are we having fun yet? Because we have plenty of volatility. And again, I found that bear market cycles are marked by an elevation in volatility. We kind of know that when you think about the VIX and what the chart of the VIX looks like, is sort of extreme all-time highs. When you have to keep rescaling your chart because it's going up so much, that tells you we're in a different regime, a different environment. And that elevated volatility is what days like the last couple of days sort of mean. I remember talking at the end of the quarter on Tuesday, on the 31st of March, how you had that whippy day that it felt like, boy, this encapsulates this first quarter and what it's felt like. And then yesterday it was sort of back to the normal bear market environment. And then today you get a little bit of a relief, a little bit of a move higher. So remember, in a bear phase, which I would strongly suggest we are still in, we are going to have big up moves and big down moves. And again, I would encourage you as much as possible, pay attention to the trend and what the overall direction is doing. That's going to keep you on the right side of things. So how did we actually finish things off? The S&P up over 2.25%, finishing just under 2527. We have the S&P mid cap up only 1%, small caps up 1.5%. So again, it was large mega caps leading the way. It was really driven by energy, utilities, some of the more especially with utilities, staples, some of the more defensive parts of the market, but energy is certainly the big winner. The VIX now down almost to 50. It's just about 50.5. Looking at other asset classes very briefly, so you did have a situation where both stocks and bonds in the positive today. So the TLT up 0.6%. That's the 10-year yield down to 63 basis points or so. Looking at commodities, you saw a broad rise in commodities. We've talked in the last couple of days about this, extreme bearish phase in commodities, but USO up oil over 16% today, almost 17%. Settled back a little bit. It was up pretty strong there out of the first hour or so of trading. But even gold, silver, precious metals up as well. So the commodity complex, broadly speaking, rallied very, very nicely. In terms of the overall sector picture, and then I'm going to look at a chart of the S&P. Energy, as I mentioned, up over 9%, finishing very strong. Utilities, number 2. So again, I remind you that even though the market's up, the market's down, don't make assumptions about sector movements. They can be very different because there's a lot of moving parts, a lot of different themes that we have to figure. So utilities, number 2 on a big update, followed by healthcare. At the bottom of the list, you have consumer discretionary, communication services, and real estate. So you've got a spread between offense and defense. It is not totally clear cut one or the others. There's really more of a rotation theme, different sectors doing well and poorly based on their own merits. Looking at a chart of the S&P 500 here, so you did get what we'd call a bullish engulfing pattern, which is a down bar followed by an up bar. And the bullish engulfing pattern, according to candlestick analysis, was really looking at the opens and closes. It might be a little hard to see here, but if you look at the last couple of days on the candle chart, you'll see the big down close and then the big up close. And today's real body engulfs the previous day's real body. It suggests short-term strength, but again, coming off a big gap down yesterday. So, so we'll have to see the low 2450 of yesterday. If you think about that pattern, a break below there would sort of invalidate that bullish engulfing pattern if you're thinking of it as a potential short-term long signal. So what we've basically done is sort of had this nice snapback rally within a significant downtrend. So I would remind you, number one, if you look further out, it's all about the highs and the lows and where they're going. So we've now seen a pretty extreme move. Depending on how you look on it, we've broken above the previous swing high. That's totally the case. But now we're chipping away and putting in this point here. And the question now is this a new higher low around 2450? My criticism or my skepticism about any sort of bull market here, and we had this great bullish divergence suggesting stocks could go higher. It's really establishing some sort of higher low, establishing a floor below which we seem unable to go. And we haven't really seen that yet, with 2200 being sort of the most recent bottoming point. So I think the next question on any sort of sell-off, if this is the middle of further downside, do we remain above those lows? Is that the new floor in the market? And as long as we do, at least there's some stability we can rely on. And we'll have to see if this is enough if we're able to follow through the rest of the week, show some accumulation and show at least some short-term support around 2450. But I think a break below there would really suggest further downside and a return to the previous lows. On the other side, just above us, we're facing some key resistance levels. So 2650 is the first Fibonacci retracement level based on the February to March sell-off. And so I think a break above there would sort of would confirm, potentially further upside. And this might be more of a time, a digestion, a bottoming process that doesn't have as much price pain. Again, all else being equal, I would not be surprised if we retest, if not go further below the lows based on some of the breadth readings that I've seen coming up until now. Let's go back to the market dashboard. Let's talk about some of the other movements that we saw. We're going to talk about relative strength. And anytime you ask me about stocks that are outperforming or doing well on a relative basis, I'm always going to point you to the Scooter reports because it's a percentile ranking based on how the trends are relative to all the other large cap or mid cap or small cap stocks out there. So if you want to know what stocks are really getting it done, look at a list of the Scooter rankings and look at the top. And this is the top decile or top 10 names out of many large cap stocks that are showing relative strength, and names that we're familiar with because we've been talking about them a lot in recent weeks. But also make a note of some of the stocks that are moving. So here on the Scooter reports, with the stocks moving up the most, it's a lot of understandable moves. It's ConocoPhillips, it's Chevron, it's a lot of these energy names that you probably have not seen on this list for too often that are all kind of coming up. But there's also some other kind of interesting names. So E-Trade is on here. Morgan Stanley's on here. These are stocks that are still, relatively have been struggling, especially on this sell-off phase, but actually putting in a potential higher low here around 3150 or so, which is actually kind of interesting. A nice rally out of those lows, up over 7% today. And again, I think we have to remember this is not happening in a vacuum. There are a lot of different themes to unpack, but potentially just starting to turn up on a relative basis, which is kind of an interesting one. Financials have sort of mentally written off for a while now. Here's Morgan Stanley, which is another one. So both of these stocks, Morgan Stanley and E-Trade, showing similar sort of patterns coming out of the lows. Now on the downside, we have plenty of stocks that are showing relative weakness or that are underperforming, showing weakness relative to their peers. That's why they're the biggest losers on the Scooter rankings. This is one. ServiceNow is actually one that comes to mind here. So again, if you don't think about the broad market environment, but just analyze the stock on its own merits, you'll see a stock that was making new highs, but then reversed. It broke down through the 200-day moving average, has now retested it from below, and potentially has failed there. The RSI turning lower, but I think this is the most important one, which is the relative strength is just rolling over a little bit. So in general, we had Tom Bowley on our special earlier this week, and I joked with him, one of my favorite quotes of his is, if you want to outperform the S&P 500, you have to own stocks that are outperforming the S&P 500. So if your goal is to do that, owning charts where the relative strength line is turning down doesn't tend to be the best opportunity. You want to own stocks where this is reversing, where things are breaking out to new relative highs, because it shows you that's where the bets are being made relative to other equities out there. So I would remind you, even in an environment where it feels like everything is sort of moving together, you have something like ServiceNow breaking to new lows. And also, if you look at something like Regeneron, you have stocks that are making consistent new relative highs. So they are out there. We just have to find a way to identify them. With that, let's segue right into our next segment, which is called It's All Relative. Gretchen, my producer, when we talked about the show, we focused a lot on relative strength at times as a way to identify, if you're a stock picker, relative strength, I would argue, should be one of your primary tools to differentiate stocks between each other, because it helps you focus on what's working and what isn't. And that question, if you can answer that question consistently, overall, I think you're going to be able to outperform a passive investment product or a passive fund or something like that. So we just have to find a way to identify those stocks that are working. So what I wanted to do today is just use a screen that we talked about a couple weeks ago. I just wanted to update some of the results that we're seeing on here. This is an idea, just looking for a long idea. So it's a simple screen. I'm taking a universe. So in this case, I'm doing the mid-cap index, so sort of mid-small cap S&P 400. And I'm looking at the stocks where over the last 2 weeks, they've outperformed the S&P by at least 20%, which is, as you can probably guess, is a pretty limited universe. I'm really trying to cut things down and look for stocks that have really outperformed over the last couple weeks. If I run that scan, it's going to give me this list right here. I ran it before we started just to sort of see what was up here. So when you're looking at mid-cap or small-cap names, you're going to start to find things that you're less familiar with. And I think that's one of the great benefits of screening. Usually we look at the S&P 500 on the show just to make sure that it's stocks we're all familiar with, and that we know who they are and what their models are and what sectors they're in and everything. But this is just to illustrate that when you're really screening for ideas, you can look across the equity landscape and potentially find some patterns you're less familiar with. So this is looking at sort of that next tier down, sort of that mid cap into the small cap space, and looking for stocks that have outperformed the S&P in the last couple of weeks. So here I found 18 stocks that fulfilled that criteria. There are a couple different ways you can do it. I usually start by looking at in sector order, just to see what sectors are emerged. So a stock that some of you may be very familiar with, depending on where in the US you're at. Jack in the Box is a lot more prominent in some areas than others. You see a home builder, KB Home, which is in that home construction group. Sabre Corp, which is a name you may not be familiar with within consumer discretionary. Then we see a couple energy names, and again, they're not my favorite chart still. And you can see the scooter rankings are still bottom 5% of all the of the space. So it's not my favorite charts, but granted, they have outperformed in the short term. Then we get a couple of financial stocks. You can see the others that are representing. I thought it was noteworthy to see a gold miner in there, RGLD, appearing in the list as well. So what I wanted to do with Zen, just pop these into a list. And let's look at the charts top to bottom. So we'll say, yep, preserve chart order. That's great. So what we're going to do now is look at these in order of how they came out here. So Jack in the Box is this one. Now, my concern with a lot of these, and again, it's outperformed the last 2 weeks. It's this little stretch right here. So it's not like it's making dramatic new relative highs. A lot of these stocks have been beaten down, but it's just looking coming out of these market lows, really. What's really accelerated out there? Where have been people have been putting their bets more relative to maybe some other names. So you can see this big move higher. And what is interesting about a chart like this is I think some charts don't have as clear of a support level. I think Jack in the Box definitely does. So right around this 28 level, that was the low from Monday's low, I want to say. So if we remain above there, it's actually holding support very nicely. We all of a sudden have this pattern of higher lows, which is what we want. Right now, we have this consolidation pattern. It's leveling in right around 32. And usually with this sort of pattern, you either have to break out to the upside, break down to the bottom side. And I'm looking at that support. And if that would hold, then it could be a compelling option here, outperforming in the short term. But again, you really want it to get above 40, breaking to new highs, price highs, to really confirm that it's worth doing. I'm skipping KB Homes because it's just not my favorite, only because it's really rolled over. And while the market is actually held up a little bit, this has actually underperformed over the last week. So all that outperformance just came out of the gaps, out of the lows. So I'm going to just go visually. So you can see what I tend to do. I use the screen to give me a list of about 10 to 20 names. And then I want to look at the individual charts to see which look interesting to me. This one, of course, is in an energy space. This is Apergy, ticker APY. And you can see that this has now established a higher low and now broken above the previous high. This is on today's close. Now, again, this is given a huge rally in oil. So I have plenty of skepticism on how this will emerge. And you can see the relative strength looks like it's just turning up, but this is up big in the last 2 weeks. This is outperforming the S&P by 10% in the last week and a half. So it's coming up very, very nicely, but have to admit it is breaking indeed to new highs. Next one, we have Evercore Partners here. This is in the financial sector. It's an asset manager. And again, another one where you have some clear support levels. So a lot of these stocks that I think, if you would take a bite at them, I think what's great is you have some really clear logical stops on the charts, right? So in general, when I'm looking at a chart like this, you look at where we're at, you look to the left, and you find the key support and resistance levels. You have resistance around 48, and you have support around 42.50. This is just from the last week, so it's relatively short term. But if it breaks down through 42.50, I think you need to be very cautious. But if it's able to follow through, we get a follow through into strength that could be compelling. One more that I want to show, and then I want to get to the scooter rankings very quickly. This one right here, ACHC, Acadia Healthcare. So again, if you look, there are actually a number of different sectors that were represented here. This one, I feel like, again, all the outperformance came last week, really, with the big moves out of the lows. Now it's sort of consolidated. And with a stock like this, it's in some ways, I remember talking with John Bollinger years ago about stocks where the volatility had come in. And in some ways, they're the easiest charts ever to trade, because one of two things is going to happen. It's not just going to stay in this range forever. It is either going to break above 19 or it's going to break below 1650, right? It's going to break above the previous high or below the previous low. And whichever way that breaks, once you have that decrease in volatility, you tend to follow the momentum of the breakout. So right now, it's sort of a wait and see which way it breaks. So with some of these stocks that have outperformed, they show that they've rallied really nicely out of the lows, and then it's all about where we're at relative to those most recent swing highs and lows. So I'd encourage you to keep a good focus on some of the natural support and resistance, or some of the natural stop outs that you could get looking at some of those individual charts. We don't have time, unfortunately, now thinking of looking at the clock to get to the scooter reports. But again, when you're thinking about relative strength, this is the first place I would probably look, besides screening, is to look for stocks at the upper end of this list. And you're going to find charts here with a relative strength line going up and to the right, which is in general how you're probably going to outperform the overall market. We need to take a quick commercial break. Back with my guest, JC O'Hara. We'll see you in a minute. Hey everyone, welcome back to the show. I'm your host, Dave Keller, here at StockCharts.com. Thanks for joining us every weekday after the close to break down today's technical action, connect the short term to the long term. I want to remind you, get your questions to us anytime. Shoot us an email, thefinalbar@StockCharts.com. We'll have another mailbag segment tomorrow on Friday to answer some of your questions. And again, dealing with an environment like this, Please use us as a resource. Ask us anything you need about technical indicators, about technical analysis in general, about behavioral biases, about market history, whatever it is. We're happy to address any of your questions anytime and help you along this ride. And to help us along the ride today, we have a great guest, JC O'Hara from MKM Partners. JC, I've known you for a number of years, and it is always a pleasure to hear what you're thinking of the markets. Welcome to the show.
Dave, thank you. It's good to be here. Thank you for having me.
Absolutely. So you sent a couple charts ahead of time, and with the technology sort of theme here, starting with the QQQ, what are you seeing here?
Well, a lot of questions from our institutional clients recently has been around, price action. And for technicians, that's fantastic, right? That's exactly what we do. And we find in bull markets, fundamental managers, pay little attention to us. But as soon as the market starts to, increase in volatility, the questions start to come into the technical guys. Is this over? What's the downside? What levels are you looking at? And again, that's great. But I feel that that's only half of the equation. And the charts I brought today really focused on volume, because I think a big piece of the puzzle that's missing and a part of the equation that is really giving us, great signals is volume. And, I brought along a chart of the, triple Qs, the Nasdaq 100 ETF. And the second chart we'll go to in a minute is the triple long leveraged triple Qs. Now, they both show, similar price action, but the volume pattern is noticeably different. And I've picked up, again, using Monday morning quarterback, hindsight is 2020, you'll start to see, different patterns emerge from, looking at the volume in the Qs versus volume in the triple Qs. So let me just walk through, what were some of the messages I've picked up on with volume, and that'll lead to, what do I think is in store for the, the Nasdaq 100 going forward. So if you look at the triple Qs on February 28th, right, the market was down 10, 12% already. We had a big gap down on the open, and then, we had a strong rebound intraday. And if you look at the volume, it was one of the highest volume days in the last 5 years for the triple Qs. So that's impressive. All of a sudden you had the buy the dippers, come back and say, hey, this is the low, let's really get aggressive here and buy. And you'll see in a second when we turn to the next page or the next chart, you didn't see that sort of enthusiasm from the leveraged Qs. And to me, that was a warning sign saying, hey, you know what? I don't know if I want to trust this rally. Fast forward a few days to March 4th on the Qs. That was another strong up day. But if you look at the volume there, that was half the volume of February 28th. So we had another strong rally, but there was no volume behind it. So all the buy the dippers were nowhere to be seen. And to me, that was a signal, hey, this rally is, suspicious. Don't think it could last. And obviously we know what happened. We collapsed until the March 18th lows. And if you look at the Qs again, look at the volume on the March 18th. Yes, it was above average, but really it wasn't anything substantial. So if you were looking for a capitulation day, you did not get that message from the triple Qs. Now, Dave, if you want to go to the next chart, we could see the volume pattern is substantially different, right? So remember that March 18th low that we were just looking at for any signs of capitulation. Well, we got that signs of capitulation from the volume in the triple Qs. That was one of the highest volume days over the last 6 years for the leverage long. So to me, that's real capitulation, because if fear and greed in stocks are escalated and heightened when you incorporate leverage. So I really felt that was, if it wasn't the ultimate bottom, it was a pretty significant low that the leverage long ETF made. And we could see over the next few days, that volume was pretty intense. So to me, that means that, guys were really saying, hey, I'm either done with this, I'm selling. But conversely, you had all the guys saying, hey, this is a pretty good battle level here, a battlefield where the bulls met the bears, and it looks like the bulls are slowly emerging. So what does that leave us? If you look at the volume today, it was pretty light. So again, that doesn't sit too well. It doesn't instill much confidence in me. But if we look at the final chart, Dave, we could wrap up, what this, what the volume is currently telling us now. And I think using a ratio of volume in the triple Qs, or the extra leveraged ETF versus, the regular ETF, we find historically when there is a spike in this ratio that we are near a major inflection point. And I kind of inserted some red arrows there to show you historically, going back to 2012, examples of when, we had a multi-month spike in this ratio. And forward returns were pretty strong, especially over the next 1 to 2 months. So currently, this ratio is at the highest it's ever been, right? So to me, it's screaming, hey, we're at a major inflection point here. So that doesn't mean we can't retest the lows. That doesn't mean we can't undercut them. But if you're a longer-term investor looking out, 1, 2, 3 months, I think, the volume in the leverage Qs are screaming, hey, this is an inflection point, and, a lot of bets are being made to the upside. So I think these lows that we're currently at, or the March 18th low, is a vital level that we should be watching on our charts.
JC, I'm so happy that we do this show and allow people to learn from people like you, but very selfishly, I'm glad that I get to talk to people like you on the show, because I've never thought to use this sort of volume ratio analysis like you just demonstrated. I think that there's really something here to this. Thank you so much for coming on, and thank you for sharing this this approach with us. It's fantastic.
Of course. Thank you for having me, Dave. I will speak to you soon, sir.
Sounds good, JC. Be well, be safe. Talk to you soon, all right? So folks, that's JC O'Hara from MKM Partners. Boy, again, you probably have seen from watching this show with any amount of time, I am not a big volume guy, but I love talking with people that use something that I'm not looking at and show some really good analysis, some interesting results with it. So a great take from JC using volume on the leveraged ETFs. We need to wrap up our show, folks, and go right to the 3 and 3. We're going to do so right now. So these are 3 charts, and boy, it's going to be a minute and a half, but we're going to make it. So chart number 1 is looking at breadth. I talk about the breadth picture, about where we're at relative to where we've been, and and suggesting that I think there's more to the bear market phase only because of the breadth characteristics. And the way I wanted to illustrate that for you is just this chart, which we've looked at before. It's looking at the percent of S&P stocks above their 200-day, the percent of S&P stocks above their 50-day moving average. And what's interesting about that, if you look at it, is even with this nice little bounce that we've had, still at no point did more than 10% of the S&P go back above their 200-day moving average. It's still 7 to 8%. Still less than 10% going back above their 50-day moving average. It's only 3% of S&P names above there. So there, again, from a breadth perspective, suggests this is less like the the end of a sell-off, but more like the earlier parts of a sell-off. I think to JC's point, the question is, how deep do we go? And I think he's right. Those lows that we established on that steep sell-off are pretty significant, and you want to look at where we're at relative to there. Chart number 2 is looking at the VIX over the last 2 years, and I'm going to show you chart 2 and 3 sort of together. Chart 2 is looking at the VIX. I've had some questions about the VIX and how quickly it's come in, and the question has been, all right, was that it? Is 8250 the peak? And now we're kind of normalizing back to where we've been. So I just want to remind you, even though we've come from the low 80s down to the low 50s, we are still overall incredibly elevated to anywhere we've been in the longest amount of time. And the way to show that is by looking at the VIX for the last 25 years or so. We're looking at the VIX at the top, we're looking at the S&P at the bottom. You can see when we got up above 40, 50, 60, we quickly went to a period with very few parallels, very few times when we've gotten this high. The only other time in my career has been in 2008 to 2009, which is when we got up into the 80s, which is what we've done recently. So even though we're down a lot, we're still above all of these historical market corrections, including the late 90s, including the early 2000s, and so forth. So again, we are still very elevated. This can whip around at an elevated VIX for a while, and at the end of the day, still appear like a pretty decent chart. Folks, that's our show for today. I want to thank you so much for joining us every weekday on the Final Bar. Thanks for coming along the ride with us, helping to answer some questions about market dynamics. Please keep your questions coming to us. The Final Bar at StockCharts.com is the best way to get them to us. Special thanks to my guest, JC O'Hara from MKM Partners. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.